Hey there everyone, Andy Cassidy, and in today's video we will be discussing if the real estate market will crash here in 2021. We'll be comparing the pre-2008 to now average credit score of loan borrowers. We'll be comparing the cash out refinance rate and the differences pre-2008 and now, and we'll be looking at the new proposed capital gains tax rate increase and how that will affect the real estate market. Starting off the video, let's look at the average credit rate score of loan borrowers from January 2020 through December of 2020. And during this time period, the average credit score of a loan borrower was 731. Now, if we compare this to pre-2008, lenders didn't care so much about credit scores. Oftentimes, they were in the low 600s. And the reason why is because a lender could give out a subprime mortgage. What this is, a subprime mortgage, is one that's normally issued to borrowers with low credit ratings. A conventional mortgage wasn't offered by the lender because the lender viewed the borrower as having a higher than average risk of defaulting on that loan. The lending institutions would often charge interest higher than conventional mortgages on the subprime mortgages, and they would often have adjustable rate mortgages. Now that we understand what a subprime mortgage is, let's look at the key issue. And to do this, we need to understand why we even have credit scores. And we have credit scores to measure a person or an institution's ability to pay back borrowed money. The higher their credit score, most likely the better they are at repaying borrowed money. That's why when we look at pre-2008 with these subprime mortgages, the banks, the lenders were giving out money to people who had low quality credit scores. And this inherently already means that they have a less likelihood of paying back the money that they borrowed. Whereas when we compare it to today's number, this 731, which is much higher, banks, lenders are giving out money to those who are more qualified and have a higher likelihood of paying back the money they borrowed. Not only are the banks giving out money to those who are more qualified with a higher credit score rating, they're also giving out better loan terms. It's much more common nowadays to see a 30-year fixed rate mortgage, which means the payment will be the same throughout the 30 years of that loan. Whereas before, not only were they giving out money to those who are not as qualified, they were also giving them worse loan terms with much higher interest rates, so their monthly payment would be higher than that of someone who nowadays has a higher credit score and a lower payment. So just to make this more simple, pre-2008, lenders were giving out more money to less qualified people and with higher interest rates. So that is not a good combination. But nowadays, we have high credit scores, lenders giving out better loan terms, typically a 30-year fixed. And if we look at this situation over here, it's much more sustainable. In addition to the credit, now let's take a look at cash out refinances pre-2008 and how they are nowadays. Pre-2008, people were able to take out 100% equity in their property. So to make this as simple as possible on what I mean, let's say a property is worth $100,000 and that person doesn't owe anything. So they have it free $100,000 in that house built up in equity. They'll pull out of the house that $100,000 they have and get cash for it and basically get a new mortgage for it. And so now they have 0% equity in that property. And that was okay back then. Lenders were fine giving out, letting people take out 100% of equity they had in their property. But here was the issue. Back then, people just thought housing prices went up and up and up until they reached a point where they didn't. And they came back down, down, down. So those who took out 100% equity in their property, let's say they took it out here, property prices go up a little bit and then starts the digression. Boom, here's where the property price is now, and they just took out all this equity. So now they're upside down on the property. And as the prices keep going down and down, the prices of real estate that is, they become more and more negative in their property. So that's when you see all the foreclosures, the short sales, and that type of thing. Because back then, being able to cash out refinance was easier than it is now, and you could pull out more money. That brings me into where we're at today with cash out refinances. Cash out refinances, most institutions will let you take out up to 80% of the equity you have in your property. What this means, let's say you have a $100,000 property and you have 100% equity. If you go to get a cash out refinance, the lender will let you take up to $80,000 out of that property rather than previously the whole $100,000. So now you take out your 80, the property value is 100,000. Even if properties fall 10%, you still have $10,000 in equity. And then let's say it fell another 10%, you're even in equity in the property value, rather than previously being upside down on the property. So that is the key difference that we see with cash out refinances. And when you put together this subprime mortgage issue, the low quality credit of borrowers, the taking out all this money out of their property, all this pre-2008, once property prices start going down dramatically, this spells disaster because you have less qualified borrowers, they have no equity in their properties or very little, and in some cases negative, and a lot of people were laid off, jobs cut hours, jobs cut pay, and it just created this frenzy of prices going down, people making less, people not being qualified in the first place for that loan. And what you see and what you get is a housing recession pre-2008 and then going into that 2008 time period. So now let's jump to where we're at today. So now we hear about this proposed new capital gains tax rate. Hasn't been passed yet, but it's just proposed. And what it is it's a new capital gains tax rate for individuals who make over $1 million a year. The new tax rate would be 43.4%, 39.6% for the highest capital gains tax rate, and 3.8% as the additional tax in the total rate. And if you add this 39.6 and this 3.8%, you get your 43.4%. And what this means is for those wealthy individuals who have a lot of money in the stock market, and if you're wealthy, you probably will have a lot of money in the stock market. It's not inevitable, but it is likely. So these people who are wealthy and have money in the stock market, they don't want to pay this higher capital gains rate when they take out their money. So what we might see and what we've had a little slight implication of is those people selling their stocks now and transferring that into real estate because they don't want to pay that new high tax rate in the future, perhaps, on those stocks. So they're going to transfer that money into real estate. And the reason why is because there's so many tax advantages to real estate. Just one quick example is a 1031 tax exchange. So let's say you have your property, you sell it, you can put that money into a property that's equal to or greater to in value and use a 1031 tax exchange to defer your capital gains tax. And that's what we might see a lot of wealthy people start doing, is selling stocks now and putting that into real estate and avoiding, for now, that new capital gains tax rate. So we look now and we see it's harder to cash out refinance. You can't take out as much as previously when you cash out refinance. Lenders are more strict on lending now, and they're lending to people of higher credit scores, which most likely means they have a higher likelihood of paying back their loan. And we see wealthy individuals perhaps transferring out of stocks into real estate. So what does this mean and what should you do? Here's what I'm telling my subscribers and my clients on what to do now that we know all this information I've laid out. what you're gonna wanna do, in my opinion, and always talk to your financial team and your CPA before you take any financial action, but in my opinion, what you should be doing is buying under market value real estate. I just shared a video recently, and I'll link that in the description and post it somewhere up here on a place that I bought that was under market value that helped build my net worth through equity in this property from buying it under market value. And that's what I recommend to you guys. And an easy example of this, just for those who aren't that aware with what I'm talking about, here's what I mean. Let's say you have a house in the neighborhood where all houses are selling for $500,000 each house. But one house puts up their property for $400,000, but it needs $25,000 in repairs. If you can buy that house for $400,000, do that $25,000 in repairs, you now own a house that's worth still, because you made all those repairs and made it look nice, they'll be worth $500,000, but you bought it for $425,000 and put $25,000 in. So let's say you're in $425,000, and so now we subtract $425,000 from this $500,000, and you just built yourself $75,000 into your net worth. And that's what I mean by buying under market value real estate. It's one of the best, one of the most efficient ways to boost your net worth. And in a lot of cases, you don't have to put all the money up yourself like you would in stocks unless you go in margin. But you can borrow from lenders, hard money, seller financing. There's a lot of different things for you to do with real estate to not put all the money up yourself. Now, I want to know what you guys think. Drop in the comments if you think real estate is going to go up or down. Now, I made my case. I think real estate will go strong here in 2021, but I want to know what you guys think. Now, if you want to know more about real estate, check out the different playlists we have here on the channel. Check out how to buy places, how to make money with real estate. All that is covered in this channel. And thank you guys for watching. Make sure to hit that like button, subscribe, check out the playlist, the videos we have here, and I'll see you in the next video.